All right, hello everyone, hope you're doing all right. Welcome back to the second video. We are going to talk about mitigation blocks. So I hope everyone has done their homework. I hope everyone has studied order blocks. Then the next thing for you to do after this video, up until Tuesday, 8:30 a.m., when we talk about the next topic, study the mitigation block and the order block. So study both things. You might notice that you like one of them more than the other. So you might like order blocks more. You might like mitigation blocks more. That's perfectly fine. You don't need to know everything in order to be profitable. Find the thing you like and run away with it. Then as well, this Sunday, 8:30 a.m., the 7th of May, I'm going to be doing a live stream here on YouTube. I'll have a reminder in my Telegram, link is in the description, and we are going to be mainly going over mindset, etc. Because I feel like a lot of people have been struggling the past few weeks, and that's exactly what I want to touch on. All right, now let's dive straight into it. So for a mitigation block, I have these few structured steps right here. The first one is pattern. The second one is a low/high. The third one is overlapping. Now, of course, the steps won't make any sense if you don't watch the videos, and that's the purpose of them. So if we take a look at the first step is pattern. Now, the first thing I want you to acknowledge, and this is very simple, you don't need a lot of knowledge for you to understand this pattern. The first pattern is basically we have a down move, just a down move. Then we have another up move. This up move fails to take out this high. This is a swing high. Swing high, swing low, we'll touch on it in a later topic. This low, this swing low fails to take out this swing high. And then we see another rejection lower. This is a swing failure. Again, that's something we'll touch on in later videos as well. So don't worry. This pattern is called a swing failure pattern. Now, what this swing failure pattern creates is a mitigation block. So right here, if we trade back into this low, there is our mitigation block. And then we continue lower. Now, the third one is overlapping. Overlapping is indicating at this mitigation block, there's another premium array, in this case premium array, because remember, we're going lower, we are looking at premium arrays. There's another premium array overlapping with the mitigation block. So that could be a fair value gap here, but that could also be what we learned in the first episode, an order block in this leg right before we take out the low. There might be a little bearish order block right here overlapping with the mitigation block. And that makes two premium arrays. That's double as strong as one mitigation block alone. So right here we have the pattern. We have our swing failure pattern. So write that down. It's a swing failure pattern. The next thing is the low. In this case, the low/high. If we turn this thing around, we have the same exact thing. We have the pattern right here. We have the high, and then we continue higher. Now, you might say, this is support and resistance. Well, yes, you're not wrong. But the thing that makes it so strong is the logic behind it. And the thing why support and resistance sometimes works is because you'll see this exact pattern. Now, the logic behind it is if we are moving lower, there will be buyers right here in this low, and they will buy this leg up. Now, once we move lower and we retrace back up to this low, then the buyers in this leg have a chance to mitigate their buy orders, aka take a loss, etc., or take a break even, and then price is able to continue lower. So for example, let's say we are retail traders, and I don't mean retail as in the individual trader, I mean retail as in the retail concepts, the support and resistance concept. Let's say we saw some nice support right here, and we are buying this. All right, we're getting a rally, perfect. Now we drop down immediately, we're in drawdown. Now the next thing, price retraces back to our entry. We are able to mitigate that order, and we can close it perfectly fine. Now there might be some traders that got in right here. And then they take a little bit of a net loss. Perfect. And that's what we need. This liquidity for price to move. Now, like I said in the previous episode, we need, for every buyer, we need a seller. For every seller, we need a buyer. Now, does that mean that average Joe behind his monitor is getting taken out of the market because his 5 lots is what the central banks and the institutions need? No. So if you ever see someone saying, oh, the market is hunting me, well, your 100 lots don't really matter. We are talking about institutions that are trading retail concepts. So the big boys, not your neighbor that's putting 100 lots on gold. No, that's not relevant. And that's important to acknowledge because a lot of people think they are getting hunted by the market just because they placed an order. This is not necessarily true. Now, if you place an order on a B-book broker, open up the spreads, they take you out, and then it continues. That's what happens a lot of the time on a B-book broker. So if you choose a broker, I'm not here for you to use my affiliate link and go to my broker. That's not what I'm doing here. Do your own research and make sure you're not trading on a B-book broker. Not financial advice as well. First, practice in demo. And brokers is something we can get into later on. All right, but that's a bit of the logic behind it, etc. Now, of course, make your own logic. If this logic is not completely true, perfectly fine. If it works for you, then it works for you. And that's all that matters. So if there's someone on Twitter that's telling you, no, you don't have the right logic, blah, 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 just tell them, thank you for your opinion. I'm going to do my own thing. No need to get into an argument or anything. We just focus on ourselves here. All right, now let's take a look at some live examples right here. Let me remove these things. So the first one, can you notice the first one right here? It's the same exact pattern that we just had. It's right here. Notice this down move, the retracement up. This low fails to take out this high. Then we have a swing failure. The swing, this swing up, fails to take out this high. A swing failure. We continue lower. And then we have a slight retracement right here. Into what? Your mitigation block right here. Now let me remove the lines just to make it a bit more clearer. And where do we take the mitigation block? The low / high. We are bearish, so we take the low of the mitigation block. This can be the absolute low of the wick. Doesn't have to be the body. So right here, boom. And again, you can apply the same logic if you want to. If that wick isn't overlapping with a fair value gap, then you take the body. If the wick is overlapping with a fair value gap, then you take the wick. That's up to you. Those minor differences, that's a little personal preference. Just because you select the wick or the body is not going to make you a millionaire all of a sudden. That's not what it's about. And that's what a lot of people think, right? They think, oh, is he selecting the body or is he selecting the wick? Just do what you prefer. Just because he selected the wick or the body, that's not going to be a major game changer. But again, if you want to make it easy for yourself, stick to the rule. If the wick is overlapping with a fair value gap, then take the wick. If the wick isn't overlapping with a fair value gap, then take the body. All right, but the last step right here is number 3, overlapping. And again, if you don't know what a fair value gap is just yet, perfectly fine. Because then later, these videos will make even more sense when you rewatch them. Not if, when you rewatch these videos. So the overlapping, if you know what a fair value gap is, what's overlapping with this mitigation block? A fair value gap. And this is exactly what makes the mitigation block so strong. And other PD arrays as well. When there's something overlapping, right here we have a fair value gap. And this is what makes it so strong. And this is as well for the advanced traders. When we notice this pattern, price doesn't have to come all the way back up into here. This is already fair value or price to continue lower. And that's exactly when a mitigation block is so strong. And this is how I like to trade mitigation block. Only when there's something overlapping, preferably a fair value gap. All right, so let's take a look at some more examples and some bullish examples as well. So right here, we have a bullish example. And again, if you do feel like it, it's perfectly fine to pause the video and try to spot the mitigation block or any other block beforehand and before I touch on it. This way you will learn faster. All right, so we have the pattern right here. We have this big up move right here. We have this down move. This high fails to take out this low and even this low. Continues higher, which creates a mitigation block. Now it's very important for you to acknowledge, and this is as well for you to write down. It's a swing failure. And write down as well, it's not a breaker pattern. Now you might not know what a breaker pattern is just yet, but it's a different sort of thing. There's a swing failure and a breaker pattern. Write it down, come back to it later on when we touch on breaker blocks, and then it will make more sense. So it's essential for us that we have this big move up first, and then a high that fails to take out the low, continue higher, which creates the high, a mitigation block. Now, in this case, if we do apply that rule, let's then take the body instead. Again, personal preference. If you want to stick to that rule, then perfectly fine, stick to that rule. The thing is, on this high, we take the up candle of the mitigation block. So here we take the up candle, just like we saw on the previous example. When it's a bearish mitigation block, we take the down candle. Now, what is overlapping? See this right here? It's a fair value gap. There's an overlapping fair value gap with that mitigation block. And that's exactly what I like so much about a mitigation block combined with a fair value gap, or as you'll see in another example, combined with an order block as well. All right, so here we have another example. Now it gets interesting. And again, these things are not rocket science. They are very simple, structured, easy steps. Trading is not a rocket science, and it's not supposed to be. If we can keep it simple, and there's a reason why we keep it simple, and that's what I touch on a lot in the mentorship. There's a specific reason why we keep things simple and why it's so important. Now, if we take a look at this mitigation block right here, we have the pattern, the swing failure pattern. We have the high, and we have something overlapping. See what's overlapping? It's an order block at the mitigation block and a fair value gap. That's 3 discount arrays at the same exact spot. Remember that, because that's important. The more overlapping PD arrays are at one spot, the stronger the defense is. So right here, we take the up candle because it's a bullish mitigation block. The mitigation block in itself is overlapping with a fair value gap. And then just below that fair value gap, we have this order block as well. Remember what an order block is? Remember the steps of getting to an order block? This is the exact steps. And this is what makes a mitigation block so super strong. All right, now let's take a look at one more example, and then you're going to head into your own chart and do your own work. Because always remember, if you don't do the work yourself, then these videos will always just be some sort of entertainment for you. Watching videos without integrating the stuff and without working on it is just entertainment, nothing more. All right, so right here we have another example, and you can see how I'm using different time frames because this is a fractal thing. Every one of these topics is completely fractal. Now, the higher time frame, the higher the time frame we use, the stronger the PD array. So if we're looking at a weekly right now, this will be stronger than a daily or a 4-hour PD array. Why? The biggest orders are on the biggest time frames. And if we know this fact, then why not focus on the higher time frame and understanding the higher time frame? Because that's where the real orders are of institutions, etc., etc. So again, the same exact pattern. Swing failure pattern, this high fails to take out this low. We move higher after this high. And this is what you'll see a lot. Right after we take the high and we close above it, we have a fair value gap right here, overlapping with the high or an order block like we just saw, and we move back into the mitigation block with the overlapping discount array. We move higher. Now remember what I said. This happens a lot when we close above this high, close, not wicking the high. And then we have a short-term return, and then we push even higher. So a lot of people will say we have this mitigation block right here. We have the swing failure pattern right here. And now we're coming back all the way down. Would you still use the mitigation block? No. I personally wouldn't. I would look at something on the higher time frame, but from what I can see, this mitigation block has already been used. We've already traded back into it short term here. This was our opportunity. Right now, we just wait for new price action. So we take the low / the high. In this case, we take the high, obviously overlapping with a fair value gap, and we push higher. Again, swing fair pattern. We close above it. And that's a little golden nugget for you if you made it to the end. We close above it. Then we have a short-term return. Another little golden nugget for you. You're getting rewarded for if you stay to the end of these videos. And then we rally higher. Close, short-term return, rally higher. Then we have the swing failure pattern, the high in this case because it's a bullish mitigation block and it's overlapping with a fair value gap. Or like we just saw on the previous example, overlapping with an order block or another discounter. All right. Now, for you, I want you to study this on your own. I want you to make up your own logic of it. I want to see if you can make up your own pattern of it. So if you recognize a few things that happen over and over and over and over when these mitigation blocks hold, but also look at a few mitigation blocks and see if you can spot them that failed. Because obviously not every mitigation block will hold, even if they are as clean as this one. And that's the reality of trading. All right, I want to thank you. Quick reminder, live stream on YouTube right here this Sunday, 8:30 a.m. New York Eastern time. And we are going to talk about the mindset, the trader's mindset, the champion mindset. And the next video on the A to Z guide is obviously Tuesday, 8:30 a.m. New York Eastern time as well. All right, thank you and make sure to do the work. Thank you.